The other pushback when I have discussions with our clients at Ausperity about Bitcoin and whether we invest into it or not, or whether they do, is somewhat, I don't understand it. So I don't want to invest in something that I don't understand. And you did a very brief, broad overview of blockchain and crypto and Bitcoin, but I feel the same way. It's difficult. For some reason, it doesn't just sink in. It's not easy for me to rattle that off my tongue. But I heard about another presentation because I'm fascinated by cryptocurrencies and Bitcoin, and I'm trying to learn as a consumer. How should investors think about it? How can this be utilized in portfolios? I think is a major aspect of this discussion. What we see here is that if you've owned Bitcoin over the last 1 year plus, it's been additive to performance because those numbers far exceed that of US stocks, gold, developed international markets, emerging markets, and then also oil. Here is something where, well, how much do we put into it? And that's where this slide kind of gets into. And I'd like you to kind of take us through the slide. Because it looks a little bit busy when you first kind of look at it at a glance. And for everyone who's listening, that they're seeing this slide for the first time. But talk through the use case for Bitcoin in a portfolio, a diversified portfolio.
Yeah, that's a great graphic. Thank you for sharing that. And this is fairly vanilla, but I think it will get the point across. So this is basically just to define the period. This is the last 10-year period. It assumes that you actually did quarterly rebalance back to whatever your baseline allocation initially was. So if you look at the first green banner, it's a traditional 60-40, right? That means you had 60% in the S&P, you had 40% in the ag, and you can see over the last 10 years, you had a cumulative return of, I'll round up to 97%. That's annualized.
Just clarify, the ag is the bond market. So 60% US stocks, 40% US bonds is your 60-40? Because I know that's classified differently sometimes.
That is correct. With an annualized return of 6.2, and then you can see annualized volatility, which is a measure of standard deviation, which is 8.5%. So 60-40, no Bitcoin exposure. And then as you work down the progression, and I think let's go to 2.5.
Sure.
Let's go to the middle. And the first point I would make is if you add 2.5% of anything, whether it's Bitcoin or something else, you're not completely disrupting your current allocation, right? So let's assume where you sourced it from. You took 2.5%. Let's say you kept 58.5% in your S&P 500 and 39% in your fixed income exposure.
Sure.
You really didn't disrupt that. So you did that. You put 2.5% into Bitcoin. Your cumulative return, you can see, went from 96% in that 10-year period to 148%. Your annualized return went up 220 basis points. So the return profile certainly looks very good, but there's no free lunch. We know Bitcoin over time has been a volatile asset.
Yeah.
In isolation, it's certainly volatile. In the construct of a total portfolio, that volatility goes down. Case in point, last year, the volatility profile on Bitcoin was the same exact volatility profile as NVIDIA, Tesla, and Meta. A lot of people own those names. So that's measured. You can see the standard deviation or the volatility. In a 60-40 with no Bitcoin, you're at 8.5% a year. And adding 2.5% Bitcoin while incrementally increasing your return 220 basis points, your volatility only went up about 4.4%.
Now I got to push back a little bit because we're using a 10-year number. And back to the previous slide, that 10-year number is at 33,000%. Now, you think Bitcoin might go to, I even forget, what is the Tom Lee target?
It's the Bitwise target that Tom Lee stole. I'm kidding. 1.3 million is our baseline case.
Over what period of time?
That's through 2035, a 10-year period.
Wow. Okay. So you are expecting big numbers and big returns. With that said, those are lofty goals. That's a massive increase. This is actually what's interesting to me is that you don't see a significant increase in fluctuation of your portfolio. And I've even noticed that as the returns have come down to earth, quote unquote, a little bit over the last 1 year and 3 year, the volatility has as well. There's some significant swings, but it's not experiencing some of these halvings and these drops of over 50% that occurred in 2022, 2023. Is there any thoughts or expectation that volatility might continue to narrow a little bit here or what?
We would concur with that for sure, Rory. And it's mainly because of the on-ramps, as I referenced earlier. 5 years ago, you didn't have an ETF. You didn't have institutions like BlackRock, Fidelity, Bitwise in the market every day trafficking in Bitcoin. It was primarily driven by individuals doing it on their own. The ownership and investor profile has really transformed into more mainstream. So with that, you would assume volatility would come down and decrease. And as I mentioned, it's been in line with those 3 Mag 7 stocks that a lot of folks own last year.
Thank you for that. Yeah, this is a great graphic, great compelling document. This is our last graphic as it relates to being a part of the portfolio. Kevin, why don't you take this one away as well in terms of what we're looking at on this screen with this chart?
Yeah, this one's a little busy, but actually it does speak a little bit to, Rory, what you just referenced. I'd rather see it on a 3-year period. What this basically looks at is, this is a 5% allocation to Bitcoin, so a little bit heavier than the 2.5 we referenced, and it looks at a 10-year period, but instead of looking at it just over a 10-year period, it looks at it in rolling 3-year increments. And in rolling 3-year increments, you can see the win rate is 100%. It actually has never had a negative contribution to a 60-40 portfolio over the last 10 years in rolling 3-year increments.
Wow.
A little bit of a busy slide.
Yeah, it is. Super.